Welcome to the ETF Show, taped here at Asset TV Studios in New York. I'm your host, Kristen Myers, ETF Editor-in-Chief for Asset TV. Now, since the start of the year, the VIX, also known as the market's fear gauge, has spiked by more than 40%. And in January, flows to active ETFs hit record highs, $65 billion, accounting for 40% of total ETF flows. Now, to talk more, we are joined now by Tyler Willams, Vice President of ETF Capital Markets and Product for Natixis Investment Managers. Tyler, thanks so much for joining us today.
Thanks for having me, Kristen. Excited for it.
So markets, to put it mildly, have really been on a roller coaster ride lately. We've got headlines around tariffs, inflation, geopolitics. How would you really characterize the current market right now that investors are navigating?
Yeah, as you said, there's been a lot going on in the first few weeks of 26, coming off some strong last 3 years. I think we've seen a little bit of uncertainty, both from a fiscal standpoint and even some of the economic metrics coming out of some of the big tech companies reporting earnings for this quarter. As you said, I think the VIX is now over 20. We've seen Mag 7, big tech, take a little bit of a step back. But the S&P still is fairly in good shape so far this year. I think the equal weight is still up. But yeah, as you said, economic uncertainty, and I think some of the big tech names with such sky high expectations might take a step back.
So when we think about 2026, a lot of people are kind of mentioning volatility being one of the big themes for this year. Are you thinking of it as something that is cyclical, or do you think volatility is becoming a, more permanent fixture of the markets that investors are going to have to manage going forward?
Yeah, it's a great question. I think volatility today is something that investors should just expect every year. I think if you look back at the S&P, one of every 2 years typically does have a 15% drawdown sometime in the mid-year. And with the information age and how fast news comes out and things shift in the economic sense, I think cycles become more compacted, and that does create short-term volatility, which could create an opportunity for disciplined investors, especially ones that have a deep understanding of the securities and markets they cover.
So with that increased volatility, I just mentioned, the flows into active ETFs hitting record highs in January. How are you seeing investor demand for actives, during this time of volatility?
Yeah, as you mentioned, I feel like every year is a record year, but last year was a record year, and they are capturing a pretty significant amount of the total ETF pie. As you said, about 40% in January, and then last year was about a third, and still only 10% of the assets. Now, I will say active comes in many different flavors, from traditional bottom-up fundamental, which mostly is what Natixis does, some of those outcome-oriented strategies, whether they're buffers or derivative income. So it comes in a lot of flavors. I think this year in particular, folks are, a bit more cautious in terms of the risk spectrum. So they are looking at some of those outcome-oriented strategies, either to protect the downside, deliver some income, or even just look elsewhere besides the U.S. Emerging markets in particular has seen pretty strong active ETF flows in the first 5 weeks of the year.
So what are some of the mistakes that a lot of investors seem to make during this time of, choppy markets? And how can the active strategies really help them avoid some of those mistakes?
Yeah, it's a great question, because I think, as I said before, with how fast news comes out now, people are looking at their portfolios a heck of a lot more, especially on a day like this and yesterday, where the markets are down at least over 1% on some of the indices. So I think some of the biggest mistakes people will make is try to time the market. Sometimes more is less. And if you are in some of the active strategies in the ETF wrapper, you kind of have a little bit of a guardrail that you have a professional manager that understands the companies that he or she is invested in. And you have a little bit more of a downside protection if they do tilt to more of those quality names that can withstand an economic downturn without an overstretched balance sheet. So in general, typical mistakes: try and time the market, relying on past winners. As I said, Mag 7 has kind of been flat to negative this year, and doesn't always mean they'll be the leaders of the market. Maybe some of the more value-oriented names have time to shine this year. And even on the cash on the sidelines, I do think people have been a little bit comfortable with collecting 5% money market rates. And if the Fed does cut this year, I think I saw the last estimate is about 2 cuts this year. That money might have to look elsewhere for compelling yield, whether in traditional fixed income or maybe that derivative income space that I mentioned.
Okay, so you're leading us right into the next topic because it's all about income. Because we've been seeing more and more income ETFs that have essentially been brought to the market. As you were just describing, investors are really looking and seeking more stability. Are there any other reasons why income has become so important to investors?
Yeah, I think just in general with the demographics, more folks are nearing retirement. It's I think less of a goal for them to grow their nest egg as opposed to spend their nest egg. The S&P these days, if you are in an S&P 500 fund, it only yields about a little over 1%, whereas in previous decades it was probably closer to 3 or 4. I think a lot of companies are doing share buybacks as opposed to paying out a dividend or just reinvesting it in R&D. So if you are in a traditional equity index, you're not getting paid that much to sit in that. So there are, I guess, appetites for different sources of income. Traditional fixed income didn't necessarily work in 22. So when you see a 60-40 both go down at the same time, you are looking for different ways to kind of get an income stream that's reliable and maybe less correlated with duration risk or what the Fed's going to do next month.
All right, so I want to talk specifically about a Natixis product. So we've got GQI that's going to be, I don't want to get the name wrong, the Natixis Gateway Quality Income ETF, a bit of a mouthful. What problem did the fund strategy for GQI really solve for investors?
Yeah, so we partnered. Natixis is a multi-affiliate shop of typically active managers. So we partner with our affiliate Gateway Investment Advisors out of Cincinnati, Ohio, who specialize in risk managed strategies. They manage their flagship mutual fund since the 70s and do take a very risk oriented approach using an option overlay to traditional equity. So this particular ETF, GQI, fits in kind of that derivative income category. I would say it solves three things. One, for consistent income generation in a world where maybe, as I said, traditional bonds and dividend stocks have shown weakness. It also gives you some downside protection in the sense that you have that consistent dividend stream from the call writing overlay, as well as taking a quality approach to the stocks that it holds in the equity sleeve. It takes from the S&P universe and applies a proprietary quality screening to folks or companies with strong balance sheets and growing margins. And then it has a flexibility, I would say, to shift across opportunities as the market presents themselves. So if volatility is up, the strategy can kind of capture that volatility and return more to shareholders in the terms of an income stream that might be higher in periods of uncertainty. And at the very least, in periods of stability, you can kind of rely on that quality equity sleeve to give you that full total return profile.
So talk to us a little bit more about, almost that tightrope, seesaw, whatever you want to call it, because how can investors really, balance that income generation alongside the downside protection, right? That they're going to want when there are these really unpredictable and volatile markets.
Yeah, I would say in general, not all derivative income has been a very hot sector of the active ETF market for some years now. I guess ever since 22, as I mentioned, when that 60-40 went down. But I would say that not all derivative income strategies are equal. Some take a higher approach to hedging more of the portfolio, generate a higher yield, but that caps their upside. And then others take a more passive approach on the equity side, strictly following the S&P or a NASDAQ. I would say GQI is a bit differentiated, that it takes a active approach on the equity side by tracking those quality stocks. And it fits with kind of Gateway's analysis of the sweet spot for where you write your calls, how much of the portfolio that you hedge and cover to give that optimal income stream that is money earned and not money maybe coming out of your principal as return capital.
So going back to this idea, right, of the active strategy, we've seen lately that markets have really been driven so much by headlines and by policy. So how and where do you think that the human judgment, right, that's a part of active management really adds alpha compared to, its passive counterparts?
Yeah, I think with the active managers that we have at Natixis, whether it's the Gateway folks or even Loomis Sales or Harris Oakmark, two of the other managers in our ETFs, they have a very deep understanding of the stocks that they own. They're less driven by macro forces because I don't think that anyone has a confident way to predict the markets. But what our managers can do is analyze the companies that they own, understanding the management team and where their goals lie, and then ultimately figuring out where intrinsic value lies and where it's trading. I think fundamentals can be an investor's North Star in these environments. And with active strategies where you have a professional manager kind of tweaking weights, especially in times of volatility when opportunities present themselves, you feel a bit better that you are, I guess, making moves in the market without actually having to trade your own ETFs.
Now, as we see actives really have, increased popularity, how are you seeing investors really think about active ETFs in their portfolios? Are they thinking about them as, core holdings? Are they thinking about them as a sort of satellite investment, something else?
Yeah, as I said, the ETF market is still dominated by passive, about 90% of the AUM still. So no doubt, a passive S&P 500 ETF might be the core of your portfolio. And active can kind of play in the satellite positions to add more diversification away from sectors like the Mag 7 and big tech, and also kind of give you a little bit of a juice in terms of the alpha potential if we run kind of concentrated high active shares portfolio that look and feel different from the index. So I think active has a bunch of different flavors. You could look at active as kind of that, like I said, that diversifier, but also a potential performance driver that does look and feel different than the big indices. And even on the fixed income side, the ag in general is pretty focused on treasuries and IGs, and active fixed income managers do have an ability to kind of get into those sectors that are a bit higher yield producing, like securitized and bank loans and high yield, to kind of, again, give you a little bit extra income as well as sector diversification.
And inflation, if we have volatility as a theme, inflation seems to be one of the big drivers of that, continues to remain a risk and a concern for a lot of investors. So how are you really seeing income ETFs addressing that inflation risk, that purchasing power risk over time?
Yeah, so inflation has kind of, I guess, hovered around the 3% range for quite some time, ever since the shock back in 22. So I would say that when you look at yields now, even money markets are still yielding close to 4.5%. The 10 years at around 4.5 as well. I would think that inflation over time, if it does stay at this 3% level, you're not getting that much real yield from these fixed income portfolios when all you're kind of waiting for is to be paid back in par within whatever the maturity is. So that's why I think that these derivative income strategies that have that equity participation, it is capped to a certain percentage, but it does give you kind of equity upside along with capturing that volatility with writing those calls. And our product GQI has yielded between 8 to 10%. So that is a real yield advantage over traditional treasuries, IG corporates, and even the high yield market, especially if credit risk is becoming more of a focus as we might enter into a period of economic uncertainty. You can still capture that yield premium over treasuries with derivative income strategies and not have those same kind of risks, as I mentioned, duration, credit, and interest rate risk.
It almost sounds right, like the income ETFs are like the white knight during some of these volatile times. But what are some of the biggest misconceptions that investors might have about income strategies, about active ETFs during these choppy markets?
Yeah, I would say in general, so active ETFs, at least for Natixis, we're fully transparent. So we disclose our holdings each day. There's no kind of secret, holdings behind some curtain. We are, out front of what we're buying, what we're selling, and on a day-to-day basis. So that's the first kind of myth that, active ETFs might not be able to give you what they're actually making moves on these volatile days. I would say in general too, especially on the income side, income doesn't necessarily mean low risk. As I said, in 22, bonds went down almost as much as stocks. So I think for active strategies in particular, you can kind of get a little bit more of that diversification and have a true manager looking at credit opportunities as they present themselves and not just kind of follow the macro environment. Active in general too, I think was maybe classified as kind of more expensive than passive. And that still might be true in some cases, but in the ETF world, those fees have come down quite a bit from the mutual fund world, and in some cases on par with some of their passive or smart beta counterparts. So I would say, in general, active ETFs have a lot of the same benefits as passive and the tax efficiency standpoint, intraday tradability, and being cost effective. That doesn't change from strategy to strategy. And they are a bit more commonplace and being used, as I said, more in investors' portfolios as either satellite positions or even core holdings.
So Tyler, just as like a last thought, if nothing else, an investor that's watching this, what would you say is the one takeaway that they should really be thinking about as they are navigating volatility right now?
I wouldn't say volatility is a problem to avoid. I think it's a reality that all investors should prepare for. I mean, when you have years of 20% returns, and even high single teens returns that we've seen in the past 3 years, volatility will be prevalent. As I mentioned, there's once every 2 years, historically, the S&P has had a 15% drawdown intra-year. So I think it's something you prepare for, and it can be an opportunity. As I said, our active managers do look at some of these downturns as ways to kind of get into particular positions that maybe were too expensive before. So active ETFs in general will give investors tools to navigate volatile markets with both flexibility, judgment calls, diversification, and then kind of that deep company by company understanding of both the business and the management team that maybe a traditional index following strategy might not give you.
All right, Tyler Willams, Vice President of ETF Capital Markets and Products from Natixis Investment Managers. Thank you so much for joining us today, and thank you for tuning in to the ETF Show.